I also welcome you for this study circle meeting on important topic of attribution. I have a pleasant task to introduce Mr. Abhay Sharma. He is an associated partner in the direct tax practice at Taxation Company and has over 11 years of experience in advising clients on direct tax matters. His areas of expertise include transaction tax, advisory, domestic and international taxation, structuring and organization of domestic and offshore funds. He is also at present the country tax reporter for the International Bar Association. Prior to joining Taxation Company, he has worked with reputed firms such as Nishit Desai and Associates and BMR. With this, I request you to welcome Mr. Abhay Sharma with loud applause. Before I request the speaker to start the discussion, I request Avinash to offer a memento as mark of our love and remembrance.
Thank you.
With this, I request Abhay Sharma to start the discussion.
Yeah, that's right. Thank you, sir, for the kind words. So the topic I've been given today is, like most topics in tax, one of those where there are conflicting judgments. There is virtually nothing settled, and when I was going through the entire jurisprudence on the subject, what I found was there is perennially been quite an ad hoc approach when it has come to attribution of profits to permanent establishments. What I hope to do during my presentation today is to basically try and bring out what are the kinds of approaches that have been followed, what is the OECD been up to recently in terms of attribution of profits to permanent establishments, and then also focus on some of the relatively recent case laws on the subject. So that I'm able to bring out at least some flavor of how attribution of profits has been approached. And please feel free to ask me any questions at any time during the presentation. I'll be happy to take them. So I think in terms of a starting point, clearly the starting point of this has to be what is meant by attribution. And before you get into the issue of what is attribution, the question that arises is what is profit? Because at the end of the day, it's the profits that have to be attributed to the permanent establishment. Now, profits is a term which per se has not been defined either in the double tax treaties and as typically judicially and through, if one is to go through the legal lexicons, it's been given an extremely wide and an extremely broad meaning. And essentially anything which is related to carrying on an enterprise or a trade has been linked to the term profit and business profit. Of course, there are those series of judgments that talk about when is something in the nature of a business profit as opposed to any other thing, where the courts in perhaps slightly different fact patterns have looked into issues such as what do the articles of association of the company and the memorandum of the association say, how often is the activity in question being carried out by the particular taxpayer, so essentially things like frequency, what is the intent, etc., etc. But suffice to say, there is no one standard clear definition of what is profit and what is business profit that one can rely on. If you look at the US model commentary, again, it is again a term that has not been defined, but the intent clearly is to cover any income from trade or business under the US model commentary. In the Indian context, as you would all be aware, it's section 28, which is the mother section from which everything flows. And starting from section 28, we have a series of sections which deal with business profits and their taxation. The way the courts have also approached it is that typically, and recently in the Kodak case also, they have more or less said that the onus has always been on the taxpayer to show that it is indeed business profit which is earning. When one looks at domestic income tax laws, essentially the approach that they have followed is income minus expense is profit, and There would be various kinds of expenses which may or may not be allowed, but the basic premise of the act is that you have income, you have expense, you set off the two, and you get your profit. So what then is attribution? Attribution would essentially be this process by which you are attributing sort of notional profits to a PE in its source state, and throughout my presentation I'm going to call a source state state S and a resident state R. So the whole idea is to somehow attribute notional profits to this permanent establishment, and there are various ways of going about that. Now when it comes to profit attribution, there is taxation of business profits in the source state or state S. What domestic law, and this is essentially section 9, what it says is that you have to look at that which is reasonably attributable to operations in India. Whereas what the tax treaties say, they also use a similar term. In most of them and in most clauses of the tax treaty, you will find the term attributable to, whatever is attributable to a PE is to be taxed as income of the PE. There are certain clauses in double taxation treaties where they have also used the word effectively connected to a permanent establishment. There are two schools of thought on whether the term attributable to a permanent establishment or effectively connected to a permanent establishment mean the same thing or not. There is one school of opinion, and there are some case laws on it to say that the term attributable to is wider than the term effectively connected to a PE. There is another school of thought which says that they are both synonymous. To my mind, it is hair splitting when you get into the concept of whether a profit is effectively connected or attributable to a PE, because the ways of distinguishing it, to my mind, would be extremely granular. So therefore, whether the term is used as attributable to, or whether you call it attribution to a permanent establishment, or whether you say it is effectively connected to a permanent establishment, essentially you are undertaking the same exercise, which is trying to ascertain what are the profits of the PE. Now, the OECD model convention, and this is the OECD perhaps has been the one organization which has done a fair bit in the last few years when it has come to this topic of attribution of profits to a permanent establishment. Now what the OECD says is that any profits that are attributable to a PE are those which the PE would have made if instead of dealing with the rest of the enterprise, it had been dealing with an entirely separate enterprise. So what is the OECD basically saying? The OECD is advocating what is known as a separate entity approach. They are saying that today, if I have to look at a PE and I have to decide what are the profits I have to attribute to this PE, I should treat the PE almost analogous to a subsidiary and treat it as a separate entity altogether to decide what are the profits that this separate entity should have. Now this is, and I'll come to it later in my presentation, but this is different from what was another school of thought which prevailed, which said that look, as far as the PE is concerned, it should not be treated as a separate enterprise. That was called the single entity approach, where they said that look, the PE is part of this same enterprise, and whatever attribution has to be done should be done on this basis. Whereas the OECD has gone with the approach, which is now their authorized approach, is that you have to treat the PE as a distinct and a separate enterprise, almost analogous to a permanent establishment. Now what this means and what this leads to, I'll subsequently come to in my presentation. Then there is the US technical explanation on DTAs as well, wherein they said that, and here if you see the slide up there, they have gone a little more in detail in the US technical explanation, and they say that profits attributable to a PE may be from sources within or outside a contracting state. The business profits attributable to a PE include those profits derived from, and this is essentially what is known as the FAR analysis, assets used, risks assumed, and activities performed by the permanent establishment. So the US technical explanation has gone into further detail and said that look, when you are attributing profits to a PE, these are the three factors that you are looking at: assets used, risks assumed, and the activities performed. the OECD, as I previously mentioned, has updated its report on profit attribution to Ps. The first report I think came out in 2008, and then they updated it in 2010, and I'll deal with that report in some time. You can also, I mean, there is also this is just by way of example. I just picked up the India-France treaty, and if you look at para 3 of the protocol, now here, as I mentioned earlier, in treaties they don't always use the word attributable. Sometimes they use the word effectively. So if you see the highlighted bits, what it says is that what is attributable to a permanent establishment and what are the profits to be determined shall be determined basis of that part of the contract which is effectively carried out by the P. They have made this observation in the case of essentially installation or supply contracts, but here the thing to note is that they have, rather than using the word attributable, they have used the word effectively, but they've used it almost in a synonymous fashion. So before I go to the international approach, it would be useful to just spend some time to look at how under the Income Tax Act, what has been the approach to attribution of profits. As I mentioned previously, Section 9, which is a deeming section essentially in terms of income, says that profit attribution is restricted to the amount reasonably attributable to the operations carried out in India. Beyond this, there is no specific guidance under the Tax Act. The income tax rule may have certain rules where there are certain guidelines laid out, but in terms of attribution and the Income Tax Act, this is where they in Section 9 they have essentially stopped. Then there was the famous circular of 1969 which the CBDT came out with, and therein again they reinforced this concept of reasonable attribution. They again said that when you are looking at a non-resident, what you can bring to tax in India can only be attributed to operations carried out in India. It is only that portion of the profit which can reasonably be attributable to the operations of the business carried out in India, which is liable to Income Tax Act. So there is, to that extent, a harmony between this old circular and what Section 911 says. There are, however, certain exclusions from the principle of attribution which are set out in Section 9. 3 of them principally. I'll skip the first one and I'll come back to it. The second one is if there is there is any collection of news and views in India for transmission outside India, that has been exempted from attribution of profits to a non-resident. Second is if you are shooting a movie in India, therein they have said that we will not attribute it to a non-resident. Now coming back to the first point, and towards the end of my presentation I'll also take a recent judgment which will highlight this point. They have excluded specifically any profits that a non-resident makes in India where its operations are confined to the purchase of goods in India for the purpose of export. Now the point here is that Section 9 is a deeming section. What the courts have held subsequently is that yes, if you are carrying on an operation of purchase of goods in India, yes, that is excluded from the purposes of Section 9, but it may not be excluded for the purposes of Section 6. And what their logic is that Section 9 is a deeming section. So if you carry on an export or activity, it will not be deemed to be income arising in India. But at the same time, based on the facts of the case, if it is found that you actually have a business connection in India in terms of you actually substantially carrying on operations in India, still it could be income that could be taxed under the non-deeming regular section of Section 6 in India. So which is very peculiar. I don't quite agree with this approach, because if you are expressly exempting something from a deeming section to say that no, it's not captured in the deeming section but should be captured under the regular section of what is the income taxable in India is a bit of a peculiar thing to do. And there is this link mark case where this principle sort of comes out. I'll deal with that separately. There is of course the famous Rule 10 in the income tax rules, and I don't know, I think somewhere in my presentation I mentioned that this rule is now an old rule because this rule came before the transfer pricing law came to India, and this is not much used. But I don't know whether that's a completely correct statement to make, because I still think there are enough instances where Rule 10 is still being applied, where the taxpayer may finally contest that the tax authorities have applied Rule 10. But I don't think we can say it's a completely dead rule. What this rule says is, if it's possible to ascertain the profit, the assessing officer should do that. If he feels that there is no reasonable way of ascertaining the profit, they have said that one, he can look at the reasonable percentage of the turnover of the company. So come up with a formula where the reasonable percentage of the turnover of the global operations can be attributed to India. Second is what is, I'll deal with in detail later, is the basically the formulary approach, wherein they've said that you take the global receipts of a company, you take the Indian receipts of the company, divide the two, multiply it essentially by the by a factor such as profits, and you then deem something to be Indian Indian taxable income of the P. This approach, in terms of just the formulary approach, not necessarily in terms of receipts, has been followed recently in 2 or 3 judgments. A couple of them I have covered towards the later half. And of course there is a residual clause in Rule 10, which says that he has the discretion, if any of these 2 methods sort of don't fit the case, he can come up with any other method that he thinks is suitable. If anybody has any questions, please just feel free to stop.
No, this first exclusion, exactly what you are trying to say. See, when there is an export,
Right.
then permanent establishment purchases are made for export.
Right.
Then in the main section itself it is covered. What is the issue there?
No, so what the courts have said is that they are saying that, look, if you have something which is excluded specifically from section 9,
Yeah.
which is a deeming section,
Yeah.
if it was anyway covered under the main section, what is the point of creating a
No, sometimes
exclusion?
sometimes just for the sake of clarity.
Clarity,
also,
but
yeah.
but the counter argument to that is that, look, that the very fact that you covered it, you sought to exclude it from a deeming section, means that it would have otherwise been covered under the deeming section, because when you exclude something from a section, means it was otherwise covered.
Many times, as I say,
For that, okay.
Yeah.
Now the point is, if something is covered
No,
under
when there is
a
an export,
Right.
then why export from India, then definitely.
no, this is a case where the non-residents' activities are confined to just purchasing goods from India and for export. So he's just sourcing goods from India.
Achha,
So he's sourcing goods from India. So they are saying that, look, if your operations in India,
from his
yes, I mean, he's sourcing and then he's moving them on. And there's a link mark case which I'll come to subsequently. My larger
Can you
point.
give me example how
So, okay, I will.
mechanism.
Okay, so I'll cover that case now that you brought it up. Now, if you look at this link mark judgment, now what happened there was this company in the BVI. It was a shell company in BVI with no real operations. What all this company did was, it used to procure goods for third parties from all over the world. So India, China, wherever they would buy goods, they would enter into a contract with this third party. They had a subsidiary in Hong Kong. This Hong Kong subsidiary was also effectively just a shell entity which did nothing except the last mile coordination as to which country they have to get the goods from. They in turn had memory serves me correct, a liaison office or something in India. Now what this liaison office did actually was subsequently the entire activity of procuring the goods, sourcing the goods and moving it on for to whoever the third party customer was. The sale, I mean the contract was not concluded by the liaison office, the contract was concluded by the BVI entity, right? Now there the question was that I think there was a survey or by the tax authorities on the liaison office. They found that these guys are not just coordination linked, these guys are effectively sourcing these products. They are doing everything possible except signing the contract, and this came to light because of some income tax survey that happened. Now because of that, the question was that they said, even if you say and you keep the restrictions that RBI has kept aside, because a liaison office cannot do all the activities they were doing, but that is not for the tax department to decide. They said that, look, even if we were carrying out all of these activities under section 9, as long as my activity of the non-res, because the liaison office is not an Indian tax resident, it is a virtual projection. of sorts. What am I doing? I am sourcing goods from India and selling and passing it on for a certain commission to third parties, and so therefore under your domestic law itself there is a carve out under section 9. So because the idea there was, because it was Hong Kong, there was no treaty protection. That's where the court said no, even if there is a carve out under section 9, you are covered under the main section. Now, which is my point. Now, normally, if you specifically exclude something from a
is good from India.
so you will
They charge commission and they have.
so BBI. Then what happened? That BBI was charging a 5%, 6% commission. They were giving 1/5 of that commission to Hong Kong, and Hong Kong was passing on just a very little portion of the commission to India. So the court said no, 50% of that commission is attributable to India. But the point I was trying to make is that look, if today at least how I would normally read a provision is, if I exclude something specifically from a provision, it means it would otherwise have been included in that provision, which I think is a fair statement to make. Otherwise, why would you make an exclusion from that provision? Now, if an exclusion is being made from section 9, which is a deeming section, special provision. So, and what it means is that normally it would not be included as taxable income, but we are deeming it to be included as taxable income. And there you are carving out this kind of activity. I would still think that the approach in that case is a little peculiar. Now I appreciate that it was almost like, for using a loose word, it was almost like a fraud of sorts being carried out by the liaison office, and based on morality and all of that, I agree that they should be subject to tax. But if you look at the way the law is worded, it is in a deeming provision that you've made a cover. I think this is a tribunal judgment. Later on, I think it's in one of the slides. I think it's Mumbai Tribunal or one of them. I'll pass it on.
So on the facts of that case, they held that liaison office is not only procuring, they are
Actually, they are doing
the
the
contract.
They are doing the contract.
Crossing the limit.
So therefore, it is taxable.
And it is taxable not under 9 but under the main provision.
Yeah.
So, and they held that 50%.
No, because they are carrying on that activity.
Yeah, they are
but
carrying
take a case where only liaison office is there,
Right.
and they are not actually carrying on any activity, then what will be the position?
But if it's a liaison activity, is not really carrying on any activity.
And they are only procuring the goods. Then
When you say procuring, see what is happening when you say procuring, what is okay? The way the RBI sees it, a liaison office is just a means of on-ground communication.
Yeah.
They are just meant to be almost like a glorified post office.
Yeah.
That they are the link in India. Now, the minute you say that they are actually going out and getting into the commercial side of the business, means that when you say you are procuring, means you are getting into the commercial side. That is not the job of a liaison office. You are talking strictly about a liaison office. There should be no question of taxation in India, because a liaison office is not meant to generate profits.
yeah.
It is.
They are not executing any
Contract in India.
They are just passing on, just information.
Information
center.
In information center. It is not a branch.
No.
It is a liaison office. So under the RBI mandate, you actually can have no tax, because if there is no income generating or activity that you can undertake in India, where is the question of taxation? But that is what is peculiar. What is happening is that if you would have noticed the trend, a lot of these cases, and I have seen 7 or 8 judgments where there has been taxation of liaison offices. Because what has happened in India is that people call it a liaison office, but in the garb of a liaison office, all sorts of revenue generating activities are going on. So the courts have taken a view that we are not concerned with what you were allowed to do and what you were not allowed to do. We will look at what you have actually done. And it was in this context that this judgment came about.
What this judgment says about your doubt that why this exclusion under section 9? Any judgment talk about that?
No, so I will have to check on which judgment says on the section 9. But what this judgment very clearly said was that you are covered under the main charging section. So section 9, even if you are exempted, it does not matter. Which to me was the peculiar bit.
Right.
Okay, so I think the first 3 bullets on this slide I have already covered. I think in terms of this arm's length approach to attribution of profits, clearly the landmark judgment was Morgan Stanley in the Supreme Court, where they said that once you have remunerated the P, and there it was a service P context, once you've remunerated the P at an arm's length, nothing further remains to be attributed. there are actually, that judgment has been followed multiple times now by multiple courts. No, P is taxable. So as far as, but what they are saying is, for the determination of the profits, you treat it as a separate entity. The rate of tax will still be 40% for the P, because the P is not is taxed at the same rate as the overseas entity. All they say is that for determination of how much profit to attribute to this P, only for that purpose you treat it as a separate enterprise. When it comes to applying the rate of tax, a P is 43.26 after all such charges.
They are remunerated at an ALP and nothing further needs to be attributed. So in that case, suppose the legal entity, let's say that the ALP comes to, let's say, cost was 20% and everything. Then the legal entity will be paying tax on that cost of 20% at 30% tax.
43.26. Acha, you are talking about a subsidiary? No, but okay. So the point here is, as far, okay, so when you come to the attribution principle, now if you see what they've done in the cases is, they are saying that once you've determined what is the arm's length, now if you are a P, okay, if you are a P, then to the extent you are a permanent establishment, now subsidiary may have other activities that it carries on which are not covered under the as part of its profits of the permanent establishment. As far as the profits of the permanent establishment are concerned, on that it has to be taxed at 40%. On that you can't, just because it is there it is neutral as to whether the P is caused by an individual or a subsidiary or a branch or a liaison office. That is not of any consequence. I mean yes, a subsidiary is a separate taxable entity, but when if it is treated as a P, to the extent of the profits that you attribute to the P, that is taxable at 43%, because the basic principle of a P, and I think it was CIT versus Vishakhapatnam Port Trust, which is that famous case where what did they say? They said that a P is a virtual projection of the non-resident in India. So the similarly the P will be taxed at 43.26%, and you will see when subsequently in some of the formulas that in the cases, I think e-funds etc. that they've applied, they have taken into account how much tax has already been paid in India at that rate of 33%, and then they have said that residual profit has to be looked at. On that residual attribution that I do, I will tax it at 43.26%. So that will come as one of the steps of the
Just one more thing to clarify, suppose an entity is accepting to have a P in India, and it is only saying that by attributing my total revenue, whatever I am obtaining from India, I will deduct only the direct cost, and don't want to attribute indirect cost at all. Whatever is going to be my headache, I have incurred it overseas. Still I end up into loss. So this kind of an allocation, will it be acceptable or any case?
Okay, so as far as the loss attribution is concerned, now this depends on what approach the court decides to take, and we actually it's actually in the next few slides, but there are two basic approaches that you can follow. Now if you go by what has been treated as the single entity approach, okay, wherein you have a situation where you look at the entire P and the foreign enterprise as one, and second is you treat it as two separate enterprises. Now in the second situation, what the approach is that, look, we are not concerned whether about anything else except how much would have been the profits that would have been earned by a separate or by a third party if a separate enterprise had done this. In the first situation where you treat it as a single entity, then you have the grounds to say that, look, overall this has been a loss-making venture. Okay, my enterprise, let's say that there is a P. There is overall that non-resident has made a loss. There is an absolute loss. Let's just for discussion's sake that he did only one transaction in the entire year. That was at a complete loss. So overall the non-resident, there has been no profitability for the non-resident. Forget his P, right?
No, I
Right.
But I'm saying that project which is related to India.
Now hold on. Now so there are some judgments. There are some where they have said that an initial period of loss for the first few years of a P is acceptable, because the name slips me, but there was this judgment whereby the P made a loss was that initially to attract customers, and I think it was a banking case where they said we were offering discounts, and that was a relevant marketing strategy for us to get more people here. In that case, I think the tribunal has accepted it. There are also a couple of other judgments, and I'm carrying those with me. So once I'm done, I can show you the section on it where they've said that a loss is acceptable. If you go, however, by the second approach, which says you treat it as a distinct and a separate enterprise, then it becomes much tougher for you to say that a loss should have been incurred, because then they say that you look at what a third party would have earned on this transaction, right? So, and which is one of the criticisms of the separate enterprise approach. It says separate enterprise, and this is what the OECD has also endorsed, that we are not concerned overall by the profit and loss situation of the transaction as a whole. We are going to treat it as an absolutely separate entity. If this had carried on this for an independent party, would it have made a profit? Yes. How much profit would it have made? Okay. But if you go by the first approach where you treat it as not a separate entity but a single entity, then you have more flexibility to say that yes, I can make a loss in India.
Yeah, but when real profit is not there, whether there can be any
Yes.
question of attribution.
Of course, there can be if you look at the
And
judgment.
the provisions of
So
arm's length, etc.
yeah. So if you take the presumption it's a separate entity.
Yeah.
Now today would a third party work on a loss for somebody? It would not. I mean, if you were dealing with a third party, would you undertake a transaction at a loss? You would make sure that you ended up with a profit, right?
Yeah.
Now, which is what, and I'll come to that slide where I've done a comparison between the two,
Okay.
where they have applied this separate entity approach. Realistically, you can't end up with a loss, because they will always say that you have a third party. If the third party had carried this out, nobody will commercially agree to work on a loss.
It also depends on the risk assumed by the third party. Say, for example, if the third party is working on behalf of the bond company, then you can say that it will earning a percentage or some part of it. But if it is actually undertaking a business,
Right.
so then there is a probability of
Fair enough. But then it also has to be looked at in terms of what are the risks actually that have been assumed in the case of a PE, because that risk comparison in a third party case may be much, the risk they assume may be far higher than in the case of a permanent establishment. Because, for instance, I'll give you one example of where the risks are not proportionate. When you talk about a third party, if nothing else, they have a contractual risk. For instance, I'm a lawyer today. If I'm dealing with a client, if he doesn't like my services, he can terminate the contract. I don't have inherently that risk in a permanent establishment. In a permanent establishment, it is my own enterprise. They're not going to stop taking services from itself, right? So,
I'm going to consider that I'm a PE and in turn I have a contract with this person.
right.
The attribution is coming out of that contract.
Then to my mind, you have a much stronger case, because there you aren't. That is income that you're generating vis-a-vis a third party. The question there still is that yes, commercially today a deal can go bad. You can still end up with a loss. The tricky part is if you end up in a situation where overall the group has not made a loss on the transaction, but you're trying to claim expenses in the P and say, but for the P level I have a loss. That is of course a much trickier situation. Sorry. Should I move ahead? Okay, because there's lots to cover, I'll just briefly mention this. I think most of us would be aware of the 2004 BPO circular. Nothing extraordinary. They've again said that arm's length principle is to be adopted. Of course, there are certain exceptions under domestic law to this attribution philosophy. For instance, all of these shipping, mineral oil related sections which endorse presumptive taxation, like section 44BB, where there is no question of finding out what is the arm's length price, etc., etc. What the non-resident is saying is, based on we are presuming that 10% is your taxable income, or the percentage of taxable income, and of that 10%, 43.26% is taxable. So effectively they are saying that we will pay 4.3% of tax. But that is where, if you've gone under the presumptive sections of the Domestic Act, then in that situation you are sort of saved or spared this entire attribution story. Because to be very honest, and you'll see that there is no consistent approach, and I saw over 150 judgments on this, and to be honest, I didn't read all of them, but I just saw it for the approaches. It was extremely ad hoc. So there are some cases losses have been allowed, in some cases losses have not been allowed because they were not directly attributable. So in some ways, if you fall under the presumptive provision of taxation, my advice always would be to go under that presumptive provision of taxation and pay that 4.5% of tax and be done with this whole business of someone trying to attribute profits to your PE. Okay, coming to the OECD approach. Now, essentially what the OECD, and these are basically summary of the Article 7 there, of part 1. What the OECD says is that, look, essentially taxation is based on first and foremost residence, unless you have income from another country. Even in that case, taxation is based on residence unless it is subject to some sort of withholding tax. Second thing it says is, if however you participate in the economic life of that country, which means you have a permanent establishment in that country, then in that case it is not a residence based taxation, then it's a source based taxation, and we will attribute profits to this permanent establishment and you have to offer it to tax. They have in their commentary gone on to treat a PE almost as analogous to a local subsidiary, just for the purposes of attribution, not for the purposes of the income tax rates. The OECD and in terms of what they say is somewhat similar to what has been what is the position under the domestic tax law, which says that you treat the enterprise as a separate enterprise and you attribute an arm's length profit to that enterprise. So this is principally what the OECD has said. It has said that the profits which a PE might be expected to make if it were a distinct and independent enterprise engaged in the same or similar activities under same or similar conditions and dealing wholly independently of the enterprise of which it is a permanent establishment. That is what they say you have to also look at. So this is similar to what has been, what our domestic law also talks about to a degree. They've also said that a certain amount of expenses can be allowed. These could be general and administrative expenses. Of course, our domestic law has 44C, which talks about a certain limit on head office expenses of general and administrative nature. And you can be allowed other directly linked expenses which are linked to that permanent establishment. Okay, so this is what I was said I'll eventually deal with. So these are the two basic approaches which have been followed when it has come to the attribution of profits to a permanent establishment. One, as I mentioned, is the single entity approach, which basically treats the enterprise as one unit and then it seeks to do an apportionment of its income based on a formula. So if you see our Rule 10, which people now say does not really apply under the income tax rules, this Rule 10 is actually in some ways following this single entity approach, whereas the Morgan Stanley decision and our transfer pricing law is following more of a separate entity approach. But as the only limit is that Rule 10 is a particular rule which sort of follows this single entity approach. Then there is, of course, as I said, the separate entity approach. Here you treat the PE as a separate and independent enterprise that would have earned profits had it been engaged in same or similar activities under same or similar conditions. And this is what you were referring to. Yeah. Now, if you look at the difference between the single entity approach and a functionally separate entity approach. So coming to one of the points that was raised, now if you see see a single entity approach, because you're looking at the profits of that entity itself, it basically imposes a limit on the profits that can be attributed to a PE. The attributed profits cannot exceed the profits of the whole enterprise. Okay, and loss from other parts of the enterprise would reduce the profits attributable to a PE. This is if you treat the PE and the non-resident entity as one entity. The functionally separate approach says, I'm not bothered if the overseas, the head office is making a loss, I am going to look at it as to what price you should have gotten as an independent third party. If you render it to an independent third party, you can have a situation where there is an overall loss in the transaction, but there is taxation in India and profits attributable to the PE purely based on this single entity, functionally separate entity approach. In an extreme situation, you can also have where the profits that are attributed to the Indian PE are more than the profits of the entire enterprise also. This is theoretical, but it can be in some extreme case also a consequence, because you are looking at this entity as in isolation and not as part of one single entity. You will see, I'll run you through 6 cases very quickly. You tell me which approach they are following, because the 2 which have been spoken about quite a bit, in fact I would say 3, although the third is not technically on this, Convergys, eFunds and Rolls-Royce. They have followed in that judgments spoken about arm's length and all those principles almost as if it is a separate entity approach that they are following. But in the end, they've come up with a global formulatory approach of a global formula. So, and in the rest, again, you see what is very peculiar about Indian jurisprudence on this subject, and it's not, honestly, one should not be overly critical, because this attribution business is hodgepodge all over the world, where they have picked up certain principles from every approach and from various commentaries, and they apply a mix of these approaches. So almost every judgment talks about arm's length price should be followed, etc. when it comes to attribution of profits. But after saying that, in almost all these judgments I find that in one paragraph or 2 paragraphs usually, in the end they conclude not based on arm's length pricing, but based on apportionment or relying on some previous judgment, and they in an ad hoc manner say 15%, 20%, 30%, and this applies not just to the tax office but to tribunal decisions, high court decisions, where there is no real attempt made to find out the arm's length price, because eventually in all these cases you will find it is not that what has been attributed has been based on some detailed study that has been done by the court on the subject. It is absolutely random, and it's a mix of both the approaches. In fact, I don't know if you recall one of the first cases that, and it had to be Justice Pramod Kumar who made a sincere attempt to come up with a scientific way of doing this in set satellite. In some ways, it is a pity that decision has been overruled by the High Court. But when he gave that tribunal decision, he was the first guy, I think, perhaps to apply the OECD approach of this separate entity. And you will see what the OECD approach is. I have put that formula down. He was one of the first guys to say that you can attribute more than arm's length. And there's a difference. That was, I said, satellite was a case of dependent agent. He said you can have an arm's length which is attributable to the dependent agent, and there can be something above that which is attributable to the DAPE. But unfortunately that decision has now been overruled. I didn't agree with his conclusion, but I thought he'd put forth his argument quite well.
Dependent agent will be arm's length.
So what Justice Kumar said is that when it comes to attribution for the dependent agent, yes, there is an arm's length attribution, but there is a residual profit attribution to the PE. Okay. And that was his approach, was based on the OECD approach, which I'll share the formula in a few slides. Okay. But the High Court has now brought it back in line with Morgan Stanley. They said arm's length, you can't go beyond that. So these were these are essential differences which I've already touched upon in the single entity and the functionally separate entity approach. This is again, honestly, this is just a reiteration of the arm's length principle of the OECD, so I will not repeat all of that again. This, for those who are interested, essentially sets out how the OECD, before we get into what their approach is, what has been the history of the OECD in this. 95 is when they first adopted transfer pricing guidelines for Article 9. Then after that, they came up with, in 2008, with the draft of this attribution of profits to permanent establishments. 2010 was when the final report came out. Now, what exactly is this OECD approach? Now, this OECD approach has 2 steps to it. The first step is you hypothesize what is the, or you undertake what is the basically the FAR analysis, wherein you say that what are the functions and that this PE is performing, what are his obligations, what is his exact nature of activity. Second, you analyze what is the kind of risk that this PE is taking. Third, you analyze what are the kind of assets that this PE is employing. Then you come to the step 2, which I think chartered accountants would know better than me as a lawyer, where you get into applying the transfer pricing methods, undertaking a study after step 1, taking into account all the factors in step 1, and you come up with a method of taxation. Now, step 1, the first thing that you have to determine is what exactly is the PE doing. So this entire text on this slide, essentially what they are saying is, please try and find out what is it exactly that this PE is doing, who is it rendering these services to, is there anybody else who's rendering services on behalf of the PE. Just try and gather that bit of information, that what are its activities, what are the rights and obligations it has vis-a-vis whatever activity it is undertaking. Next it says, you try and understand what are the significant people functions that are being carried out by this permanent establishment. Now, what is meant by this term significant people functions is there in the bracketed part, but essentially what it means is, one is what the taxpayer claims is being done in India by the PE. You also try and, but you based on the facts of the case, try to ascertain that if a particular activity is being done. So for instance, I'll take the case of let's say a fund in the fund industry, where you have a situation where every fund has an investment advisor in India, and there has been, and even post the budget, there still is this whole debate on whether the investment advisor can be a permanent establishment of the fund or of the investment manager. Now the investment manager and the investment advisor, how it works in the fund industry is that they have a contract wherein this investment manager tells the investment advisor that, look, there is this fund which has hired me as a manager. I am sitting in Mauritius, so I have no knowledge of what is happening in India. So you will sit in India and you will just do market analysis and tell me what are the places where this fund can put in money. That is what basically the contract says. It is people like me draft it and we put in 20 pretty useless things that the investment advisor will do. Factually what happens is that the entire brains of the fund is sitting in India. The investment advisor is the guy, because the guys who are running the investment advisory are actually the guys who put this fund together. They are the ones who are actually deciding, like, these are my target companies to invest. These are the risks that we are taking on by this investment. And once they make that decision, then it's a question of paperwork where they will give a recommendation to the manager. The manager will accept 7 out of 10. They make a further recommendation of whatever, 5 out of 10. But that is a question of paperwork. Effectively, all the work is being done in India. And overseas, actually, the manager is just an administrative body. And this is in most cases. There may, of course, be some exceptions. Now, that is what they are saying here. You figure out where are the significant people functions being done. Where is it that the PEs what are the risks that are being assumed at the PE level? In the example that I gave you, legally the risks are being assumed by the manager or by the fund, but realistically the risks are being assumed at the PE level. That is what they are saying, that you attribute risks to the PE based on where the significant people functions are being carried out. Similarly, they say, and that's on the next slide, that you attribute assets to the PE based on whether significant functions of the PE are being carried out. So let's take another example. Let's take the example of some sort of a manufacturing activity being carried out in India. Now you may have a situation where a non-resident is using assets which belong to him in India. So hypothetically, let's say there is a machinery which belongs to a foreign company which they are using for manufacturing in India. Now legally the ownership of this machine is with the overseas entity, but factually it is being used on ground here, right? It is being used on ground here. So where is the significant people function with respect to this machinery being carried out? It is being carried out in India. So they say that you please recognize the fact that the significant asset deployment is being done in India. Significant risk in my first example is being done in India, and take that into consideration. And why should you take that into consideration? Because if today, for example, in my second example of manufacturing, if I have to attribute profits to a PE, and the taxpayer says, look, this PE in fact doesn't own any assets, so therefore whatever you attribute, please take into account that the actual productive function that it is doing is very limited. But that is not the actual fact of the case. The actual fact of the case is that the real use of that machinery is being undertaken in India by the people who are forming that PE. So they are saying that you take, and if a third party who was independent you had told him as a subcontractor to do third party contract manufacturing, he would have charged you for using his machinery. So it stands to logic, if that machinery is being used in India, whatever price is being or profits are being allocated, there should be a higher attribution because that machinery is located in India. Similarly, in my previous example about risks, if an investment advisor is today taking substantially all the decisions for a fund sitting in India, so actually he is taking the risk on, although on paper he is not. You have to take that into consideration, because if a third party, the higher the risk for a third party, he would have charged you more. Similarly, for an investment advisor, the higher his risk model, the more he is, or at least should be attributed to him if he forms a PE. And this is what they are saying you should look into when you decide what is actually going on in this FAR analysis of yours. And once you have done this, you also look into two other factors. You also look into actually one other critical factor. You attribute a certain percentage of capital of the non-capital, and I mean by this the the free capital of the non-resident to the permanent establishment. What they are essentially trying to say is, and this is where OECD is trying to treat this PE as a separate subsidiary in India. They are saying that, look, today when anybody takes on a risk, if any company takes on a risk, it has to have a certain amount of capital, because tomorrow if that risk becomes a reality, it is only the capital that you have which will help you offset that risk, right? We don't want a situation where just because this is a PE, right, what the overseas or the non-resident says is that, look, all my as far as this PE is concerned, this is purely being financed out of debt, and there is an interest cost associated with it, so please lower the profits of this PE. They are saying that if there was an independent third party, there would have, which was taking on risk, it would always have to have a certain amount of share capital based on which it would run its business, based on which people would agree to do business with it. Because nobody today will want to do business with someone who's taking on a risk but has actually no skin in the game, in terms of it has actually no share capital which can back that risk. So I mean today, and India does not have thin capitalization rules, but today a private limited company can have 1 lakh rupees of share capital, right? Now if I theoretically have a private limited company in India which has 1 lakh rupees of share capital, rest is all a loan, and it is and I've hired it, and it is, let's say it's a third party, it is doing substantial work for me. I may have 10 clauses in my agreement to say that if this happens, you will pay me this, you will be liable for this. But at the end of the day, if that company is thinly capitalized, I know that all what I've written in my contract is worth nothing, right? So I will insist that I will only deal with someone who has a certain level of capitalization, so that if he is giving me a certain promise or a guarantee or certain liability or risk that he is undertaking, he actually has the substance to take on that risk. So they are saying for a PE also you do the same. We will not allow a scenario where you keep saying that the PE ko to be internally fund, and therefore in fact there is an interest cost linked to this, so if you please apportion some interest cost also to this PE. So they have said that please take all of these factors into account, and then you start the business of you get the chartered accountant to do a transfer pricing study. You can use any of and the OECD approaches are fairly similar to the ones prescribed under the domestic tax law, and then you get into this business of which method to apply, etc. Now I'll stop here, and if you can just reflect on for a second, I don't think any judgment in India has actually bothered to get into this kind of a depth of analysis when it comes to actual attribution of profits to a P. And this is what is actually known as the separate entity approach. Now they have claimed to follow the separate entity approach, but they have not done any of this. They have said separate entity, arm's length, interest of justice will be served by 20% attribution. That is the pretty much how it has gone. But if they were to follow the OECD and India is not a signatory, this is the level of detail that you have to. Yeah, I will wait for. I will actually eat later. 1 second. Then I'll keep sitting. It's fine. Next is this business of which is there in some treaties, and where some treaties say that if you have a permanent establishment, what you should attribute to this permanent establishment is not what is just directly attributable to the permanent establishment. You should also attribute to it that which is indirectly attributable to the permanent establishment. Now the Linklaters judgment, I think it is a tribunal judgment of the Mumbai High Court, if I'm not mistaken, but the point is there they have erroneously treated indirect attribution to a P as similar to what is the force of attraction principle under the double tax treaties. Force of attraction is a totally different thing. Force of attraction principle to a P says there are some treaties which India has where it says that if you have a permanent establishment in India, not only are the profits that are attributable to this permanent establishment taxable in India, but if you are carrying on any same or similar activities or services as that you are carrying out through this permanent establishment, even that will be taxed in India. So for example, let's take the example of Coke USA. They have a permanent establishment in India, they don't, but if they did for selling Coca-Cola, right? So they are selling Coke through this permanent establishment, profits are being attributed to the permanent establishment, tax is being paid at 43% in India. Because the US treaty would have a force of attraction rule, what the tax authorities can say is, yeah, this much is attributable to the Coca-Cola you're selling, but independent of this, not through the P, you are independently selling juice also in India. And because there is a force of attraction rule in the tax treaty, not only will the profits of that you get of selling Coke through the permanent establishment be taxed in India, but because there is a similar activity you're carrying on of selling juice in India, which has nothing to do with the P, even that by virtue of this force of attraction is to be taxed in India. That is the force of attraction principle. Erroneously in Linklaters they have said that anything, if a treaty says there is a direct, even profits indirectly attributable to the P are to be taxed in India, they have said that is similar to force of attraction. To my mind it is not. And why it is not is, when you decide what is indirectly attributable to a P, it still means, and there are other judgments that have said this, that there still has to be a link to the taxable transaction that you are talking about. A force of attraction, if God forbid, if any taxpayer falls under force of attraction and it actually applies to him, then what the P's activities are only half relevant. The other activities have nothing to do with the P. But when a treaty says profits attributable directly or indirectly to a P, indirectly attributable also means there has to be some relationships, some nexus has to be established. Not like the Coca-Cola and juice example that I gave you. So the point is, so the point is, if it is, then it is an activity carried out by the P, right? What force of attraction says is, even if you don't do it through the P, okay, so let's put more facts into this example. I have a P through which this whole distribution channel is happening for Coca-Cola. Coca-Cola also owns certain juice brands. Okay, they commercially take a call that iske liye we will not involve ourselves. We will have a third party who will act as an independent distributor in India, right? On arms, like totally different from the P. under force of attraction, there is a risk that even those profits can get attributed. Now, those are not activities I'm carrying on through the P. Different example. If a law firm has a permanent establishment in India, because of one client deal that they did, if they do another client deal, where a different set of lawyers came, has nothing to do with the first deal, but it is a service of a same or similar kind that I've rendered, even that will get attracted. So that's the force of attraction. So there is no indirectly attributable element here. That is a much wider concept. And what I'm saying is also, if you look at the Article 7, so Article 7.3 of India, UK, or Article 7.3 of the India-UK Treaty, right? And this is where they have said, they have hinted at what is something called indirect attribution. They said that, and this is I think in the context of a DAP, they said that where a permanent establishment takes an active part in negotiating, concluding or fulfilling contracts entered into by the enterprise, then notwithstanding that other parts of the enterprise have also participated in those transactions, that proportion of profits of the enterprise arising out of those contracts which the contribution of the PE to those transactions bears to that of the enterprise as a whole shall be treated for the purpose of paragraph 1 of this article as being profits indirectly attributable to that permanent establishment. So what they are saying is that there is still a causal link. They are saying that if there is a particular activity, there is a profit, even if you have participated in it directly or even indirectly, you can attribute. But not like the force of attraction that they are saying in link letters, where they are saying that if a treaty says profits of a PE, direct or indirect attribution has to be done, it is as good as force of attraction. No.
Here again, attribution would be not the whole profit, right? Indirectly attribution.
No, it's fine. I'll keep sipping. Yeah, I mean it should not be, but it depends on facts of the case. So, for instance, if you look at that, in some of the judgments where there's an absolute fraud being carried out, actually it should be the entire profits that should be attributable. I think when you're looking at attribution, two things are critical to my mind. One is, of course, determining what activities that are being carried out, and second, looking at what sort of profits and on what basis you will do that attribution, because we should not get too carried away only by the percentage that is being allocated. What is also as important is that is a percentage of what. Okay, so I will not be unduly concerned if tomorrow someone even says 40% attribution, but the bigger question is what is the base, 40% of what. So it's not a single answer that I can give to this. You'll have to look at it holistically. So you'll see in one of the cases where the tax authorities, what they did was, there was a P, admittedly there was a P. They said that look, आपका global revenue कितना है, पता नहीं, some $1 billion. Let's do a head count of how many employees you have across the globe. Okay, now India has cheap labor, more employees, so we will divide it by the number of employees, and उसके बाद we will say what percentage of profit. I think it was convergence, if I'm not mistaken. Okay. For me, forget the percentage. That first part is shocking, right? Because 40% or 50%, even 10% of that. So their attribution was in, I think, to the tune of a few billion, based on that. Because they said, India mein agar aap India mein dekho, and there when you do something like that, you don't even recognize whether a guy is senior, junior, what level, right? You are simply saying ki 1000 employee India mein, 10,000 across the globe. So I will do an attribution to this thing. So India may have a factory and may have out of those 10,000 in India, 9,000 may be working in a factory. Does that mean that you will do the same level of profit attribution as the other employees? No. But to me that is scarier than just the percentage. Percentage though is one part. So then fortunately it was overturned. I mean they didn't accept the tax officer's submission on it, but they came up with a new formula which I've covered in this. So this is actually the last bits of my presentation where I'm going through some case laws on the subject.
We are talking about a PE which is having a one line of business.
Yeah.
And a similar activity which PE could have carried out, but it is not carried out by PE but the entity itself.
Yeah.
And hence it will be indirectly attributable to
I don't think there I have an argument still, to be honest, because there, at least the way I read the law is, what they are saying is that look, you have to talk about profits which are indirectly attributable to the P, which means that that activity is something which has been undertaken by the P. In your example, you're talking about a situation where the P is not undertaken it. That can only get covered in force of attraction.
Yeah, force of attraction.
Force of attraction is, I mean, touch wood, I've never had a client who's said that, with the tax authorities have, we've fallen in a force of attraction situation, because that is then a totally different thing. So what you're talking about is more FOA than indirect.
Head of income being with,
Sorry?
head of income is seen with. So my PE is earning a business income.
Yeah.
Whether my foreign entity is earning say FTS or a managerial.
So I mean, see, no. So then the question is it same or similar activity? The point is, so if you see the two examples I gave, the activities are fairly similar. Coca-Cola, orange juice, and law firm with okay. But I mean, so let's say in that same example, Coca-Cola example, and I'll take your thing of let's say royalty. Let's say Coca-Cola tomorrow says that I will give जो हमारा secret formula, we will license it to someone in India, and I'm getting a royalty stream from that. Then I think you can't apply force of attraction there, because my first income is of a different type of activity, which is sales of actual cold drink. The second is I have licensed my proprietary Coca-Cola formula. That is royalty. So there I don't think you can link the two, even under force of
Under
attraction.
force of attraction, you are saying that the example of Coca-Cola and juice, something can be attributed.
Yeah. Coca-Cola juice can be attributed. Coca-Cola formula royalty cannot be attributed.
And then the advocate law firm also you said.
There is a yes.
Because but then that activity has not been undertaken by that.
But you see the presumption, and which is why it is okay. So the let's step back. So the OECD model does not even have this force of attraction concept. It is more from the UN model. The fear is, and I think as the gentleman mentioned, that today they sort of assume and presume that if I have a PE for one thing and I'm carrying on almost the same activity as that, तो कहीं ना कहीं तो PE कर रहा होगा. That's why we will attribute it to the permanent
Some of our
establishment.
treaties that is there.
Yes, there are plenty of treaties which have the force of attraction rule.
And that is applied in connection with this attribution.
Attribution. So you have a P. Now you have a P. First problem.
Yeah.
Then you attribute profit to it. Second problem. Then the question is, they will attribute other profits of other similar activities to the, because their assumption is always force of attraction basically means that they are going with the premise that somewhere the P is involved. So we don't. So even if you prove to us that it's not involved, under FOA it will be covered. Sorry. No. This is purely a treaty-related concept. Now, to anticipate your question, if you say that why not go under the Act then? But the Act has its own set of challenges in terms of the threshold it has for creation of a business connection, for example. So, while for a P I have a higher threshold, I may have a lower threshold in some cases under the Act. So, yes, one solution can be that I can opt to go under the Act to say that, अच्छा यार, I will pay what is to be paid to my business connection, but please don't attribute the rest of it. But it may not as a solution apply in every case, because what may happen is that your other activities which may not have otherwise formed a P under the Act can fall under the business connection concept. So you have to take a decision based on the facts of the case. There is no standard answer that if I am getting hit by force of attraction, I will get saved under the Act. There is no standard reply to that. Okay. And now to the cases. Come to this. Yeah, let's start with this. This essentially the takeaway from this case, and to be honest, I have already touched upon the main principle of this case, is that where you have presumptive taxation under the Act, attribution to the PE cannot happen, because I have under the domestic law taken a call that I will be taxed based on gross receipts under a special section. The tax authorities cannot then say that no, forget section 44BB, this is a PE, we will apply principles of attribution. That will not happen. In this particular case, what the Supreme Court and what had happened was that what is one massive problem in a PE situation? Normally a non-resident does not maintain separate books of accounts for the Indian permanent establishment. I mean, on a lighter note, I always say PE is like love. But you don't intend for it to happen, but it happens. So, I mean, there's a similar situation with the P. So, the taxpayer is normally not prepared in most cases. They have not accounted for a permanent establishment. It has happened. Now, post facto, for them to maintain accounts for a permanent establishment is very, very challenging for many reasons. Not least of which is this issue of how do you allocate expenses, how do you, how do you allocate salaries, etc., etc., how do you allocate revenues. So, they typically do not maintain books of accounts. The only places where normally upfront people maintain books of accounts are, in these EPC kind of situations where people are coming as a joint venture and 3 entities are forming an AOP. There, yes, they maintain books of accounts. But in most kind of Ps that you see where it is a non-resident rendering services in India forming a P, he's not kept separate accounts for India. So the court said that look, it doesn't matter whether you maintain separate books of accounts, etc. Normally it would have mattered because you would have had to do a transfer pricing study on it. In this case, where a presumptive section of tax applies, there is no question of getting into the question of attribution of profits to a P. Even if you have a P, please pay 4.3% tax and be done with it. This case is an interesting case. Now here what happened was, I think this was a case where SAIL had hired these people for, they have this plant in Rourkela where they said that we need to modernize this plant, and they hired these guys. I think they were Germans. They said that these Germans will provide us designs and drawings and also of what is to be done in the plant, how this modernization is to happen. They'll also give us certain knowledge of how the actual erection of the plant and machinery is to be done. As part of that, the contract said that we'll have an Indian third party who will erect the plant. You please send a few people to India to supervise the entire construction based on your drawings. So these drawings came absolutely sealed, cleared customs and came. The German entity sent people to India and effectively they ended up having a P in India. That is not the question that was in dispute. Next question obviously was, okay, P ho gaya, now what? How much profit should be attributed to this permanent establishment? And now this, and why I picked up this case was because for me this is just one example as to how ad hoc attribution of profits in India is. Now if you see what the court has attributed, the tribunal has attributed 10% of the profits to the P. They have, and I think the Supreme Court judgment of Hukum Chand, which they always rely on and say that based on the Hukum Chand judgment and one or two others, between 10 to 15% is what serves the interests of justice. What they basically said was that, and you read the highlighted part, it says it was contended that since design and engineering details are prepared in Germany, the P in India had no role to play, and therefore no profits attributable can be attributable to the same. We see force in this submission. The P in India is admittedly a supervisory P, and it is should be difficult to postulate that it had any role to play in the preparation of the design and engineering services. Okay, so this makes me think that they are not attributing any profit. Then you look at the next highlighted part. They say, however, the possibility cannot be ruled out that the P in India had a role, however small, to play in the effective commissioning of the plant. After receipt of design and engineering in a packed condition, the supervisory staff making use of them in the effective installation and commissioning of the plant supplied by the assessee to SAIL. For such activity, it will be fair to estimate 10% of the total receipts as attributable to the P. Now, and this would probably be the last paragraph or the last but one paragraph. So after reading the judgment, it's not as if I've understood what is really the basis, it's just an ad hoc approach. As I said, 10% is fair. And what is surprising in this case is, they are saying that we are not even sure whether that supervisory P played any role. But they are saying, यार आया था तो जरूर कुछ ना कुछ तो करा ही होगा, इसलिए we think it's 10%. So that's what they are saying. The supervisory staff of the P must have certainly helped in implementing them. So there is no surety on this aspect. They have said that okay, शायद हुआ होगा, तो 10% is fair. So this is a Delhi tribunal judgment. It shows a level of ad hocism. I wouldn't cover link mark because I've already covered it. This was the case that I had spoken about with respect to, I think, the attribution when it came to section 9. this was that case that I was referring to, where there was a sourcing of goods. Yeah.
Mentioned you have given feedback for contract third party India for installation of all this. They are just provided to design and work.
No, so see that practically what happens if you see all of these contracts, and we have tried to structure with such type of clients. Ki look, how can we break this up for you? How do we make sure that this PE thing does not happen? Now what happens here is, and I'll give you a live example of a client of ours which is based in Maharashtra. So they are also largely into not this kind of design, but they do city planning and designing, a large level of that level of planning and designing. Now we said, hey, look, what are you doing? You are making these designs great, but why are you sending these people along with it to implement? अगर आपको भेजना है तो you please second them to your Indian subsidiary, you depute them. Okay. Now practically what happens is with all of these people is that when there are contracts that are so big, different people play small roles in that entire contract. Now practically on ground what happens is one guy may come for 30 days, then he is not needed in that contract. Then the next guy comes for 30, 30, 20, 30. So when I add up the days at the end of the year, it comes to 200, 250. Now their problem is they say that look, I can't firstly, I can't depute a guy for 30 days. There are visa challenges now that they are getting stricter. For that guy to uplift him, say that for 1 month it is a deputation, his whole payroll goes for a toss, and one guy may come for a week. For every guy, I can't do it. And there they have somewhere taken a practical call almost that this is an exposure that we'll eventually live with, because practically we can't. Second part to your question, that can I ask a third party to do it? It can't, because it's like saying that I will buy a Ferrari, but I will ask the Audi mechanic to come and put the parts together and in my plant to install it. It cannot happen. If these guys have prepared those detailed drawings, these guys know every component. In this case, they were also helping them, if I'm not mistaken, procure spares and all for those plants. These are the guys with a great level of knowledge and expertise, because this is their baby. A third party cannot, it's because it's not like an AC or something that this guy gave me the design, this guy is coming and doing the installation. These are highly specialized projects, and also you may have situations where the service provider or the guy who's giving the design will say no, because this is my proprietary information. I have certain intellectual property here. I don't want you to go and disclose it to third parties and have third parties involved in this, because hoga kaun, it will be a rival only who will come and do the supervision. So, and this is again, this is the sale plant. So this will be, I'm assuming, very high level kind of machinery. So it is not practically possible. In paper, yes, but I don't think practically you will be able to do it. As I said, this case I'm skipping because I've already covered it. This was an interesting judgment in a Mumbai tribunal. Basically, here what happened was that the foreign bank, they were giving loans to people in India. Now, India, of course, has the external commercial borrowings regulations. So you can't. There are certain limitations to what you can do directly in terms of giving a loan. So they were not breaching any of those. What they were simply doing was they were giving loans, signing those loan contracts overseas. Of course, these were to big clients. But what was happening in India was they had this Indian branch. This would do the credit analysis to see whether the person is credit worthy or not, what is his capacity to repay, and what is the risk element in undertaking this entire activity. They said we have a P, branch is anyway a de facto P. There is no question of it. But then our friends in the tax department said, yes, we agree it's a P, we attribute 25% of, and this is where the of becomes more important than the percentage of the total amount of interest that the foreign bank receives in as by giving the loan. 25% of the commitment fees, 25% of the arranger's fees received by the foreign branches. The taxpayer said, look, you attribute something of whatever percentage to the commitment fees, arranger fees, or what people like me who are always in debt understand more easily, processing fees and things like that. But you can't say that the interest component that is going, that you attribute 25% of the interest to me, because that is the money of the foreign branch. They are giving a loan, they are earning the interest, they are taking that credit risk. You can't say that 25% of the interest that you earn overseas is mine. They approached the tribunal upheld this. They said that, look, you can only please exclude the interest from the purposes of attribution. That was the real relief they gave. They brought the 25% down to 20% or something, but that was not what is important of the judgment. They said you take the interest out. You only for the fees that you're charging the client, some portion of that. And this is exactly to the point that was raised earlier, that the percentage is not what is always important. It is what is the base that percentage is applied on. Okay, I think I have two other big cases and then I can conclude.
Some interest is not to be attributed?
No, nothing. Because they said that, today, it's like saying, let's take a different example. What does CIBIL do? CIBIL as in the credit bureau agency. Now today CIBIL has a report on me. CIBIL says that whether I am credit worthy or not, right? But that doesn't mean that the bank ka interest would you have to say that part of the bank's interest, if the bank gives you a personal loan based on the CIBIL report, will the bank, will you attribute interest to CIBIL? You will not, right? CIBIL is not earning that interest. A similar activity is being done by their branch here. They are getting into the question of credit worthiness. So I think it's only fair that you don't attribute interest to it. But this is a great case, because this and the next case, I think the last two main cases that I'm going to take, this was an awesome case because there was no P in this case. So this was a typical outsourcing arrangement, and of e-funds. There was some back office related activity, and honestly I have read this case a fair while back. Even then I didn't pay much heed to the facts of the case because they said there is no P. But what is very important in this case is that after deciding there is no P, and I wish more courts would do this, they said nonetheless agar P hota, so how would we have attributed profits? And it's peculiar ki jahan hota hai P, they don't bother to get into the principles, and in this case there was no P, but they decided we'll come up with something. Now here these guys essentially followed, now I would call this more of a like a global formulary approach. They said that look, and which is actually this is derived almost from Rule 10, but they said that what you do is, if you have a P in India, first you look at the overseas assets of the total assets of the non-resident. You divide that with the Indian P's assets. So you'll come up with some percentage or some ratio ki global assets including Indian assets itne, divide by what are the Indian assets. Then you see what are the global profits of that non-resident. Then जो आपका पहला रेशियो निकला है, उससे you multiply the global profits. Whatever you get are the profits that are attributable to the Indian P. From that, of course, you minus whatever the P has already offered to tax, but whatever is the residual profit is the additional profit. Now, when you look at a method like this, and you know, I don't blame anybody. I mean, we should not criticize a judgment like this purely based on the fact that look, that they've said this, can this apply in all situations and all. I think when it comes to attribution, you have to take a case by case call. For example, if you see the approach they have laid down here, they've said an asset based approach basically, right? An asset by profit. Yes, it can work, but it depends on what you're talking about, right? It may work for a manufacturing kind of a situation, but it will not work for a services kind of situation. Yeah, I mean, if I don't have assets, I don't have assets. So, but to be fair to the court, they have laid down an approach, but in terms of application, you can't say that, and this is actually the problem of attribution, and it is not, there's no single solution to this, but you have to appreciate that different approaches have to be followed for different situations. This will not work in an asset light situation, but I think why this case has always stuck out for me is that they made an attempt at least to come up with a formula for attribution. This perhaps has been one of the more talked about cases of when it has come to converges, and I think this is the last main case that I intended to take. Now again, facts are not relevant. Just to bring everybody up to speed, basically this was call center and back office services. Admittedly, there was a PE in India. What the taxpayer was saying was that even if there is a PE in India, you attribute whatever profits you have to attribute. Please bear in mind that the PE does not undertake much risk, because one of the biggest risks in any business is client risk. They have no client risk. Clients, we feed them. Okay, we are taking care of their most of their expenses. There's no novel R&D that they are doing. R&D is also done overseas. So please keep these factors in mind. They did dispute, but that was not really the crux of the case. Yes, they had a fixed P, dependent agent P, service P. They had all sorts of diseases. But the point is that the question was that how much should be attributed to this P. Now, and this is where this decision, and I'm sorry, the last bit has slid down a bit, but I'll still cover it. Here is another approach put forward by the Delhi Tribunal, and this is not an asset-based approach. Here they say is that what you do is you look at the foreign enterprise's global operating profit percentage. Okay, and why? So then it struck me that why have they said that you look at the global operating profit percentage from customer care services? Because customer care was what was being undertaken in India, like any call center. Then when I went to the case, I found out, because in this case, on record, they had the filing with the SEC in USA, where they had to mandatorily disclose this profit percentage. So they said, first let's look at what is this. So globally, what is the profit percentage from customer care services? Next, what you do is you have to decide and figure out what is this foreign enterprises operating income from Indian operations. So how do you decide what is this foreign enterprises operating income from Indian operations? You first find out what are its total revenues from contracts where services have been procured from India. Okay. After you have done that, you multiply this with that first percentage that you've got. So what are you multiplying? You are seeing what are your revenues from India from customer contracts which have been serviced in India. You multiply that with your total profit percentage. You will come up with a figure of what is the operating income in India. Once you come up with this figure of what is operating income in India, this will help you in deciding how much profit is attributable to India. You take this figure that you got above, reduce from it the profit before tax of the Indian P, because the profit before tax of Indian P is anyway being offered to tax, so you can't tax it twice, and whatever is left is the additional profit that has to be attributed. Now if they had stopped here, it would have been okay, because I'm just taking it a few slides back. If you remember the old case where they followed a different approach, they stopped at this step, right? They said that to find out the profits attributable to the Indian to the PE, you take the profits attributable. You take the foreign profits that are attributable, reduce from it the profits of that are already been offered to tax for the Indian P, and whatever is the residual P, you further attribute it to the Indian P. So that is where they had stopped. Here what have they done? And I'm sorry the last bit is cut, but they said that the interest of justice will be served if the profit that is attributable to the Indian P, you multiply by that by 15%, and that is the additional amount you should tax. Now why they gave them this concession of only 15% and not 100% of this figure that they arrived at is not clear, because again this is just an ad hoc approach. They said the interest of justice will be served. They relied on Hukumchand judgment, etc. again, and my point is that look, whatever is left after this step 4 is what is the additional profit that you have to attribute to the P. Where is the question of 15%, 20% then? 15%, 20% though is a concept where you are looking at what are the overall revenues of the group, and you say 10% as allocated. When you've done this study, you found out what is the profit attributable to the Indian P additional. Why they gave them this luxury of 15%, I don't know, but they did. So it shows this thing. Okay, before I conclude, these are two small cases not relevant to a large degree, except to the fact that just because you have a nil TP adjustment, that does not mean that you cannot have a further profit attribution for a P. Second, in this Hyundai Rotem case, they said that that Rule 10 is not a tool of first resort. You cannot just say that I will, as a tax officer today, say I have Rule 10, I will apply Rule 10, I will say 20% of your global revenues are taxable in India. You have to have a sound basis if the taxpayer has a transfer pricing study to reject that study in the first place, and you have to establish that either that study or his books of accounts are not reliable before you randomly decide 10% or 20%. To conclude, what are our findings? I mean, what is the situation today? I think everyone says every area of tax is one of the most complex subjects in international tax. I would actually say it after the end of most presentations, but I'll be honest as a lawyer for once, this truly is one of the most complex areas of international tax, because it is not that I can today or anyone can say that, look, forget India, US they have got this right, they have figured it out, or Canada has figured it out, or Belgium. Nobody has figured it out. Every country is facing the same issue when it comes to attribution. Some may be slightly more evolved than India, some may be less evolved than India, but there is no country which can today say that we have got a perfect system going on this. It is not possible. It is the inherent risk when it comes to transfer pricing, which people, as they often say, it's an art and not a science, but that is an inherent problem which is there. It is truly one of the most complex things. Yes, there is, whether you say there is limited judicial guidance, or whether you say there is conflicting judicial guidance, or whether you call it ad hoc judicial guidance, or whether you say that every case is different and the facts are different. The fact of the matter is, today there is, in every case, you can't just blindly rely on a judgment and say, oh, this applies, I will apply it here. Today taxpayers don't have any certainty, which is why today even when we advise our clients, we only advise them to the stage of saying, try to avoid having a P in India. If they ask you the next question, Acha, if there is a P, then what? I honestly don't have an answer, because I can't tell him today कि आपका इतने का 43% जाएगा. I don't know, because the last time one of my clients ended up having a P was a few years back. Was this guy who was a fund whose investment advisor was held to have a P. The markup that the tax authorities came up with was cost plus 77%. Okay. Then there's a second judgment where they've come up with cost plus 44%. So I today am in no position to tell any client that that a cost plus 77% is this thing. So and which is what I said, a P is best avoided. You can never give any comfort to any client today if you have a P, how much to attribute. I have seen a 77% case, so I don't know what else to say. Yes, please do maintain proper documentation to take care of this, because ultimately what happens is that a tax office will do whatever it has to do, but at least make sure that when you go to the tribunal, you have this documentation on record, because it's only at the tribunal or the High Court that you have some hope that they will look at it more objectively and look at this documentation. I keep telling people and I keep telling clients that the approach to people to transfer pricing has to change, and admittedly I'm not an expert and this is not what I do every day for a living, but as a reasonable man, what I feel is, why is transfer pricing in India today done only after the event is over? Like, transfer pricing study is done after the payments have been made, after everything is done. At the time of filing the return, you have this irritating form to be filled. You should use it as a way of guiding how you actually run in the country, right? Similarly, if you have a P and you think that your activities will create a P, please do the study upfront. And also, this will perhaps be some other day I can speak on this. There is the OECD is working very hard on this BEPS, or the base erosion principles. It's something that they are cognizant of. In many ways, I think Indian tax authorities will be delighted that they are working on this. In the days to come, if their recommendations are accepted, with the way the OECD is going is, they may tomorrow you may have a P in India because the website is being accessed in India. There's this new concept that they've come up with, which says it is not about physical location of server and forget all of that. It is about virtual digital presence. So if Flipkart server is in BVI, I don't care. Its customers are here. It has virtual digital presence here. So there is now a stream of thought that the threshold for PE should come down. PEs will become more and more frequent. So attribution will also become more and more frequent, which is why please do maintain proper documentation. That was it. Thank you.
Any questions, friends? No questions?
So yeah, so Flipkart is an example, but so what has happened typically in these PE situations is you have always had the concept of server PE, but PE to today in digital trade, who keeps the server in India? You have the server anywhere in the world, right? It is an uplink. But so today, I mean, and honestly, I don't know Flipkart's business model. That was just an example. But let's say a more American company like an eBay has a website, ebay.in. I pay by credit card, right? And let's keep the RBI and regulatory issues aside. Let's say they don't have a server in India. If they don't, they have a server in Ireland. Okay, VAT does not apply. There are no taxes that are being applied. There is no attribution of profits that is happening in India. eBay.in is almost exclusively for Indian customers. So now, because all these big digital stores have specific India related websites, so what OECD is saying is even something like that we will tomorrow teach a digital presence, and they've done a huge report on BEPS, and there are many more situations where PEs can come in, like there are commissioner agreements where it could come in, and many other situations that it can come in. The point is that the way the world is moving, having a PE is going to become easier and easier, and therefore the linked question, if PE then attribution, will become more and more important.
Thank you, Abhay, for reading 100 and 150 judgment for us. That is what you mentioned in your lecture.
So I mean, not all this
No,
week, but
you
yeah.
have gone through it. At least you have gone through it, and that is what he was telling me in the beginning of the lecture. That we consider this to be an opportunity to update our knowledge. That means he believes in sharing the knowledge. Thank you once again. Before I request Deepesh to perform well-deserved formal vote of thanks. Announcements. First, about the tomorrow's lecture meeting, that is on black money bill, where Mr. Sanjay Sanghvi, advocate, will be the speaker, and Mr. Nishit Desai will be the advocate, will be the chairman. That is on the 4th floor of this IMC building. It is jointly with Indian Merchants Chamber. So my request to you is, those who want to attend, kindly block your seat and come early, because it is joint program. We are expecting huge rush. And now our next meeting is by the Allied Law Study Circle meeting, that is on 29, day after tomorrow, in Babubhai Committee room, next adjoining room. The topic is role of professional in bank finance. One Ms. Rekha Nayak from Union Bank of India will be the speaker. Thereafter, on 7th May, we have meeting on Ind-AS by Mr. Anand Banka. This will be the third part of the meeting. That was because of the members' demand. We have kept the third meeting also because he had lot to share. For Direct Tax Study Circle members, there is a meeting, study circle meeting on 12th May, wherein we will be discussing this ICDS, 3 ICDS, construction contract, inventories and revenue recognition. Speaker will be one Mr. Sanjeev Pandit, Chartered Accountant. With this, I request Deepesh to propose a well-deserved vote of thanks.
12th May, 7th.
Sorry?
12th May or 7th?
12th May is ICDS, 7th May is Ind-AS by Allied Laws Committee.
Thank you, Sharma ji. Not much of codified law is available on attribution of profit to P. Hence, it adds to complexity. Further, it is facts based. Mr. Abhay Sharma covered what is business profit, how as per DTAA domestic law, profit is to be attributed, judicial decisions on the subject. I on behalf of Chamber thank Mr. Abhay Sharma for enlightening us and request him to carry out with loud applause.
Thank you very much. Sir, I was telling him, I'm not doing money, I'm doing it after that. I don't eat.
Achha, you don't eat.
Sir, because just
What about dinner?
No, dinner I will have only dahi and something with that, but I do not eat.
That is the raj of your health, your stomach.
No, sir, the problem is that every day I reach home only at 10:30, 11. Normal days में इतना हो जाता है.
So dahi is sufficient.
With dahi and I eat something with it because what happens is so we don't get any time to exercise other than weekends. Saturday, Sunday. So there has to be some control on diet.
In morning what time you start?
So morning I it's 9:30. It's I mean
Very hectic.
Very hectic. So I mean like you have and if you don't work with business then you know you can let little bit by example because very hectic these days. लोग जा रहे हैं. Anyways, thank you so much.
Thank you.
Absolute pleasure.
Yeah. Thank you, sir.
Thank you so much.
Thank you, sir. वो अलग नहीं वो 12 पर थोड़ा किया अभी एक कुछ अभी अप्लाई अच्छा पीएम से आते चलो